Welcome back to the Deep Dive, where we plunge into the most consequential, capital-intensive trends shaping our future and give you the essential knowledge you need without all the hype.
Right.
Today, we are looking at something, well, it's staggering. It's the sheer unprecedented flood of money into artificial intelligence.
I mean, we're talking about global capital flows that really rivaled the late 90s, but they're moving so much faster. And it's all driven by what feels like, genuine, verifiable breakthroughs.
It truly is a moment of just dizzying scale when you see proposals for over $1 trillion in infrastructure spending, and that's just for the foundational elements.
And you watch single companies, briefly hitting market caps in the multiple trillions.
Yeah.
The classic unavoidable corn just pops up.
Are we, right now, in the middle of an AI bubble?
Exactly.
But that binary question, is it a boom or is it a bust? It's often all you hear. And it's just an overly simplistic framing.
Yeah.
It really obscures the true nature of the risk and, frankly, the opportunity.
It does.
So our mission for this deep dive is to move entirely beyond that. We're going to be using the remarkably rigorous framework from one of the true fathers of modern deep learning, Dr. Andrew Ng. We're diving into his seminal thesis, which he really articulated in the batch, issue 329, and then refined it throughout his analyses in 2024 and 2025.
And Ng's work is really the key here. He argues that the AI market, it can't be treated as a single thing. It's not a monolith.
Not one giant speculative asset.
No. Instead, it's a sophisticated composite structure. It's made up of 3 distinct economic layers.
And each layer has its own rules.
Its own economic physics, as he puts it. It has its own unique risk profile, and it's attracting capital in wildly different ways.
And that structure is what we're calling the tripartite stack. The conclusion Ng reaches, which is, honestly, it's shocking, is that we're currently experiencing a structural valuation inversion.
Which sounds complicated, but the idea is simple.
It means the foundational infrastructure, the stuff you need to create the AI, is possibly overheating. It's being overcapitalized.
While the layer you need to actually extract value and generate revenue from it all,
The application layer.
that's being structurally undercapitalized.
Yeah.
Starved, even.
That inversion is the very definition of market instability, right?
It is. It's the source of all the current anxiety, but it's also the blueprint for the massive value creation that could still be to come.
So the question isn't whether the tech is real.
No, the tech is real. The question is whether the capital has been routed correctly to actually realize all that potential.
Okay, so before we jump into the structure of this inversion, just a crucial word on context. As always, the analysis we're providing is based purely on publicly available sources. It is strictly for educational purposes.
We're synthesizing information to help you get better informed.
Exactly. This does not, and it must not, constitute investment advice. We really urge you to conduct your own thorough due diligence before making any investment decisions whatsoever.
Okay, let's get into it.
Let's establish the ground level. Let's start with the scale of the investment, because you really need to feel the weight of this capital to understand Ng's analysis.
Right.
Analysts are tracking over $1.4 trillion. That's specifically proposed for AI infrastructure projects. Global.
And this isn't just theoretical money, like a projection. This is actual CapEx planning. If this gets executed, it fundamentally changes global economic dynamics.
And that scale translates directly into market cap figures that are, like you said, just hard to process. We've seen periods where single entities, the dominant ones in hardware like NVIDIA,
briefly held market caps that exceeded the combined GDP of major established nations.
It's unbelievable. It reflects this fundamental rapid reallocation of capital. It's moving away from traditional industries, oil, real estate, manufacturing.
And going straight into specialized data centers and silicon fabrication.
But if everyone is pouring money into this one sector, and we have multiple companies valued this highly, well, this is exactly what raises that prevailing anxiety. Skeptics out there.
Like folks at Janus Henderson and other big institutional funds.
Right. They point to the revenue gap.
And the revenue gap is the core structural fear. It's simple, really. It highlights the mismatch between the inputs and the outputs.
The money in versus the money out.
Precisely. The inputs are the colossal amount of money, the CapEx, being spent right now on chips, on power infrastructure, on cooling systems.
And the output is the money that's currently being earned from AI software and services.
Yeah.
The actual realized revenue.
So if you commit $1.4 trillion to building these AI factories, but the software running inside those factories only generates, let's say, $150 billion in annual net profit.
That equation doesn't work.
It's economically unstable. The money spent vastly exceeds the money being earned back to justify the expense.
And the risk, they argue, is simple. If the demand for that AI software, the application revenue, if it fails to accelerate fast enough to close that gap,
A rapid corruption is inevitable.
which leads to a deflationary shock across the whole tech ecosystem.
And that's where Ang steps in and says, wait a minute, you are asking the wrong question.
He thinks the critics are looking at it the wrong way.
Yeah, they're treating the AI market as a single speculative asset, a monolith. Ang fundamentally rejects this framework.
He argues that viewing hardware, APIs, and the end-user solutions as just one big bucket of risk, it blinds us.
It blinds us to the actual structural drivers of value and volatility.
Okay, that's a crucial point.
Sure.
But if the entire value chain ultimately depends on the underlying silicon and data centers, why isn't the risk profile shared? I mean, if the foundation model collapses, doesn't the application layer collapse with it?
Not necessarily, and this is where the analogy of the early 20th century electrification era becomes so powerful. Ang uses it masterfully.
Right. Think back to that time of immense transformational technology. Capital flowed rapidly, creating multiple distinct speculative waves.
Exactly. You had bubbles and things like
Copper mining, right, the raw material infrastructure.
copper mining and specific local utilities building out the distribution networks. And those investment cycles, they had their own busts and consolidations. But N points out that those infrastructure bubbles were structurally and financially separate from the eventual massive durable value created by the electrical appliances themselves.
The refrigerators, the motors, the lighting systems.
Exactly. The fact that some copper miners or specific utility companies failed did not negate the long-term value of electricity itself and the applications it enabled.
So applying that analogy now, the bubble risk in the copper mining, which is the manufacturing of specialized training chips,
It's fundamentally separate from the lasting value creation in the electrical appliance.
which is the high ROI AI application.
We have to decouple them to assess risk intelligently.
And that brings us to clearly defining the three layers of Eng's tripartite stack, because the rest of our discussion really hinges on this segmentation.
It does.
Okay, so layer one, training infrastructure. This is the factory environment.
It represents that colossal burst-oriented computation you need to create the intelligence to train the massive foundation models like GPT or Llama.
It's the specialized high-intensity environment of discovery,
Right. Then you have layer two, inference infrastructure.
the runtime environment.
Yes, these are the computational resources required to execute those trained models for end users, delivering the AI services in real time, day in and day out. It's the utility company delivering the electricity.
And finally, layer three, the application layer. This is where the rubber meets the road.
It's the user interface, the final product, the specialized service that solves a real-world, high-value problem.
The economic utility, the appliance itself, the medical diagnosis agent, the automated legal review system.
Right, and we have to remember this structure. Eng asserts that capital is currently pooling aggressively and potentially dangerously in layer one.
While layer three, the only layer that can provide the cash flow to justify layers 1 and 2, is being starved.
That is the valuation inversion we need to understand.
Okay, so let's focus on the bottom of that stack, training infrastructure. This is where Nang explicitly suggests that while he's, still optimistic about the overall AI sector,
He's cautious.
he's very cautious. He says this particular layer is facing intense pressure and could also be a bubble. It represents the highest financial risk.
And the risk is just baked into the nature of the investment required. I mean, training state-of-the-art models involves assembling hundreds of thousands of the highest performance GPUs.
We're talking clusters that require immense power draw, specialized cooling.
All into singular, bespoke computational centers. It's just an inherently capital-intensive process, a massive, non-dilutable CapEx commitment.
And the primary structural mechanism that really amplifies this bubble risk is what Eng highlights as the depreciation trap.
Which is made even worse by the physics of Moore's law.
Right. Traditional assets, like a steel mill or commercial real estate, they might hold their value for decades. But AI training hardware, it's operating on this accelerated timeline where technological obsolescence can happen in just months.
Just consider the financial absurdity of this speed. Let's say you commit $1 billion to procuring and installing a cutting-edge GPU cluster in 2023. That investment is meant to have an economic lifespan that justifies that cost. However, because of architectural breakthroughs, the move from, say, Hopper to Blackwell or whatever comes next.
That same computational power, or better, can often be acquired for half the price just 2 or 3 years later.
Which means the original billion-dollar investment suffers instant, catastrophic technological depreciation.
It's a race against time, where the asset is literally shrinking in value faster than the training process can even be completed.
Eng calls them fast depreciating assets. If your billion-dollar cluster is training a model that takes 18 months to complete, and the technological benchmark shifts dramatically in month 15,
the massive premium you paid for that 2023 performance is it's incinerated capital.
the hardware might be repurposed for inference later, sure, but the premium paid for that state-of-the-art training capability is lost forever. And that investment carries, as he says, minimal cash flow to show for it during that entire training phase.
And compounding all of this is the competitive saturation, what he calls the foundation model race redundancy.
Right now, you have dozens of entities. Big tech, well-funded startups, sovereign funds, all building overlapping proprietary infrastructure.
They're all chasing the same finite pool of demand for these general-purpose LLMs.
Exactly.
But if the utility of AI is as vast as we believe it is, shouldn't the market support multiple foundation models?
It should support some, yes, but probably not dozens of them, all commanding multi-billion-dollar premiums.
That's a good point.
And Eng points out the competitive threat from open-source intelligence, particularly models like Meta's Llama series, which are, rapidly closing the performance gap.
So if open source models become good enough for, say, 80% of enterprise needs,
Then the marginal cost of intelligence trends towards zero. And when that happens, the pricing power of the proprietary models just collapses.
and all that massive capex that was spent building rival proprietary infrastructure, it can never achieve the predicted returns.
It becomes a classic overinvestment cycle.
And here's where the financial engineering comes in, which makes the bubble even harder to spot: the circular risks that create synthetic demand.
Oh, this is straight out of the 1990s dot-com and telecom playbook.
It absolutely is.
I mean, think about the mechanics. A major cloud provider, a hyperscaler, needs to demonstrate revenue growth to justify its own enormous capex.
Right.
So they invest billions into promising AI startups. But often it's not in liquid cash. They offer cloud credits.
So Startup B gets $5 billion in funding. But crucially, that money is contractually obligated to be spent entirely on cloud provider A's compute services for training.
Exactly. So cloud provider A, the infrastructure owner, books that subsequent cloud usage as revenue.
Which looks great on their quarterly report.
Of course, but it's not organic demand. It's subsidized demand.
It's synthetic demand generated through vendor financing.
So if the model builder, Startup B, fails to secure real non-subsidized revenue from the application layer, if their business model just collapses.
That $5 billion in cloud revenue that cloud provider A booked just evaporates.
And the expensive training clusters they built become stranded assets. This whole mechanism means that the current apparent demand for Layer 1 infrastructure is potentially inflated, masking this underlying financial fragility.
It's a powerful, self-fulfilling cycle of investment that only works if that top layer, Layer 3, delivers real cash flow.
Which makes the training layer the most unstable part of the entire stack.
Okay, let's transition now to Layer 2, inference infrastructure. If Layer 1 is that high-risk, volatile environment of discovery and incubation,
Layer 2 is supposed to be the stable, predictable environment of execution.
and we need to clearly separate the two, because Eng claims that even amid this capital flood, inference infrastructure still needs significant investment.
And that is the counterintuitive observation, isn't it? How can the market be saturated with chips, yet still require more investment?
Right.
The answer lies in the technical specification and just the nature of the workload. Training is about solving one massive problem quickly. Inference is about solving billions of small problems efficiently.
So training requires these massive, synchronized GPU clusters with extremely high interconnect bandwidth, like NVLink. They need to coordinate computation across thousands of chips simultaneously.
But inference is fundamentally different. It often runs on smaller, isolated clusters or local servers or even edge devices like phones or specialized industrial machinery on a factory floor.
So what inference requires isn't that brute force synchronicity.
No, it requires efficiency, low latency, and energy optimization. You need the model to run cheap and fast, not just big.
Which means that the expensive, high-performance training chips are often inefficient or just overkill for these run-of-the-mill inference tasks.
Precisely. And the economics of demand are completely distinct. Training demand is periodic, it's bursty, and it's consolidated among a few dozen well-known players.
Right.
Inference demand, however, is continuous, it's real-time, and it's distributed across millions of enterprises and billions of end users globally. The total potential scale of inference demand dwarfs training demand by orders of magnitude.
But there is a utilization gap right now, isn't there? I mean, we have the chips, but the apps haven't scaled fast enough to use them all.
We do, and that's the central caveat. The exponential growth Eng predicts for inference compute relies entirely on the successful deployment and scaling of the application layer, Layer 3.
So if AI applications succeed in achieving labor substitution, generating vast amounts of value,
then inference demand will explode, making today's capacity seem totally insufficient. Eng's strong call for continued inference investment is therefore a direct, calculated bet on the success of the applications above it.
and if that bet pays off, this layer suggests a fundamental shift in the architecture of AI deployment. It moves away from the centralized, winner-take-all dynamics of the training layer.
Where only the giants can play.
Exactly. And it moves toward a more competitive, decentralized, and ultimately commodity market for execution.
Which is a crucial structural component for the long-term health of the entire ecosystem. If intelligence itself becomes cheap to use, it removes a major barrier to adoption for small and medium-sized enterprises.
So if Layer 2 becomes a commodity, it lowers the hurdle for Layer 3 applications to scale rapidly.
Effectively fueling the whole stack from the middle.
So while Layer 1 might be a bubble driven by high capex and rapid depreciation, Layer 2 is more like an undervalued workhorse.
Where efficiency and distribution will be the key economic differentiators going forward, rather than just pure horsepower.
Okay, so now we get to the core of Eng's thesis, the valuation inversion. We have massive capital in Layers 1 and 2, but Eng identifies Layer 3, the application layer, as severely underinvested.
And this is the paradox. The only layer that can generate the cash flow to justify the entire multi-trillion-dollar infrastructure is being systematically starved of capital.
What's causing that?
The cause is a deeply ingrained fear among venture capitalists and institutional money. The fear of the giants, or as it's often called, Sherlocking. They've been burned before.
Yeah, okay, explain Sherlocking in this context. It implies that anything a startup builds can be just instantly copied.
Precisely. It's the fear that if a startup builds a highly valuable, successful, but ultimately generic AI feature, let's say an automated customer service triage bot specialized for small businesses,
The model giant, whether it's Google, OpenAI, Microsoft,
will simply absorb that feature into its next native API update. The startup is instantly rendered obsolete or Sherlocked.
and the VC investment is wiped out.
Right. Why fund a company to build a feature that the platform provider can just give away for free next quarter?
That fear, while it seems rational on the surface, it leads to paralysis. And N argues that this paralysis is based on a fundamental misunderstanding of how complex real-world value is created.
He contends that the recipe for building infrastructure, buy chips, pour concrete, secure power, it's conceptually simple and quantifiable. It's easy for a generalist investor to understand and model.
But the recipe for building a truly successful, high-value AI application
It's complex, it's messy, and it's deeply specific to a vertical. It requires proprietary domain data, navigating these Byzantine workflow integration challenges within legacy enterprises, and earning specialized user trust.
And that complexity is precisely what generalist capital struggles to evaluate.
But that's where the defensibility lies, hidden in that complexity. And that leads to Eng's fundamental economic truism, which has to be correct for the entire AI economy to survive.
The truism is just simple arithmetic, really.
It is. Almost by definition, applications have to be more valuable than the infrastructure, since we need them to be able to pay the infrastructure and technology providers.
I mean, if the application layer doesn't generate more revenue than the layers beneath it cost, the entire structure is just a house of cards.
It is.
So if we are currently in, let's call it scenario A, where the total revenue generated by applications is less than the total cost of the infrastructure.
And you have to include depreciation and debt service in that cost.
Right. Then the bubble bursts. The market fails to sustain itself.
The path to sustainability, scenario B, absolutely requires the application layer value to explode. It has to generate enough high-margin revenue to service the debt taken on to build the data centers and the chips, and still provide a profit margin for the application builder itself.
Which requires applications to do things that generate massive, verifiable ROI.
Yes.
So how then does a startup survive that threat of Sherlocking? Eng advocates for an almost aggressive defensibility through deep vertical integration.
The key is moving away from the generic, A generic writing assistant is highly vulnerable. It's an easy feature for a foundation model to absorb.
But consider something else, a regulatory compliance agent for FDA filings in the pharmaceutical industry.
Now that is different. That requires proprietary access to internal document repositories, an understanding of changing regulatory schemas, integration with specific legacy validation systems, and a certified audit trail.
And those elements act as a massive economic moat.
A moat that a general-purpose model simply cannot cross with a new API endpoint.
So the insight here, for you, is that smart capital needs to execute a dramatic rotation. It needs to stop funding generic, easily replicable foundation models.
And start funding the intensely complex vertical workflow agents that solve multi-billion-dollar problems for a specific industry. That's where N says the potential value is still much, much greater than the market currently recognizes.
Okay, so if the application layer is the necessary savior for this AI economy,
Then the enabling technology that will finally drive that massive revenue jump is the shift from simple chatbots to complex agentic workflows.
this is the difference between a minor efficiency gain and outright labor substitution.
And this distinction is crucial for you to grasp. We're moving the conversation away from model size, which is mostly PR hype, and toward functional capability, which is business reality.
So let's define the shift in the unit of work. The chatbot, that's the old paradigm, it's essentially a productivity aid.
Right. It speeds up human work by performing information retrieval or some basic drafting. It competes with low-value, low-margin activities like a basic Google search or a junior employee summarizing a document.
And you might see a modest, 10 to 20% productivity boost?
At best. And that is not going to close the trillion-dollar revenue gap.
Okay, so then the agent. This is the new paradigm. This is a true labor substitute.
It is. It's a system that can take a high-level goal, plan the steps necessary, use external tools to gather data, execute the necessary code or interactions, and then iterate until that goal is met.
And this competes directly with high-value labor.
A specialized analyst, a junior developer, a paralegal.
And it's this agentic capability, defined by Eng and others, that has to drive the superior economic performance needed to justify the infrastructure costs.
He highlights 4 essential characteristics that empower agents to achieve this level of autonomous performance.
The first, and maybe the most critical for reliability, is reflection.
Reflection is the agent's ability to critically assess and critique its own output before it delivers a final result.
So like a coding agent, it doesn't just generate the Python code.
No, it executes the code, it captures the runtime errors or failing tests, and then it uses that feedback to automatically debug and refactor its own code until the tests pass.
Or a legal agent writing a brief.
It reviews its own output against established case law databases, internal style guides, identifies inconsistencies in tone or citation, and then fixes them autonomously.
This self-correction loop moves the software from being a suggestion engine to a truly reliable worker.
And that drastically increases the trust a human supervisor can place in the system, which is absolutely essential for enterprise adoption. The second characteristic is tool use.
This sounds fundamental for real-world integration.
It is. A chatbot is often confined to the data it was trained on. An agent has to step outside that training box.
It needs robust, reliable access to external APIs.
Like running a financial query via Bloomberg, or checking real-time inventory levels through a SAP system, or interacting with a browser to navigate a third-party website.
So the agent becomes a coordinator of external services.
Stitching together complex digital actions to achieve a business outcome rather than just generating text.
Okay, the third is planning.
And this elevates the agent way beyond a simple prompt response. A human gives the agent a high-level goal. Design and implement a marketing campaign targeting small businesses in the Midwest.
The agent doesn't just start writing copy.
No. First, it breaks that high-level goal down into subtasks. Analyze target demographics, draft 3 ad copy variations, identify relevant ad platforms, allocate budget, set up tracking.
And then it manages the sequential execution of those tasks.
Requiring minimal human intervention to move from step 1 to completion.
And finally, the most advanced characteristic, multi-agent collaboration.
This mimics a specialized, decentralized human team. So instead of one monolithic AI, you have several specialized agents working together, each with a distinct persona or skill set.
So you could have a data scientist agent analyzing customer trends.
And a copywriter agent generating ad text based on the scientist's findings.
And a chief marketing officer agent reviewing the strategy and approving the final budget.
Exactly. They communicate and negotiate internally to produce a robust, multifaceted solution.
So this combination, reflection, tool use, planning, and collaboration, this is what enables that massive productivity jump required to close the revenue gap.
Let's use that coding example again to show the economic impact Eng is pointing toward.
Okay?
If you have a developer using a basic chatbot, they might get a 20% speed boost. They still have to review, debug, and plan everything.
But if that same developer is managing a swarm of highly capable collaborating agents, a coder agent, a reviewer agent, a debugging agent,
the human's role changes from hands-on keyboard to pure supervisor and product owner.
and that human can become, what, 500% more productive? Or even manage multiple projects at once.
That level of efficiency generates application value, the ROI that is functionally commensurate with the billions poured into the infrastructure.
That 500% jump is the only thing that transitions us from scenario A to scenario B.
And N is betting that these agentic workflows, the green shoots he sees in specialized areas like legal contracts, drug discovery research, automated finance,
will grow into a dense forest of ROI, generating the necessary billions to pay the high cost of the underlying compute.
To properly measure the risk inherent in Eng's tripartite stack, we have to look at the historical precedent, the dot-com mirror of the late 90s and early 2000s.
Right. There are clear structural parallels, but there are also crucial divergences that suggest this boom is fundamentally more stable, as the sources suggest.
Let's analyze the primary capital source difference first. In 2000, the capital flooding the system was largely driven by speculative IPOs, highly leveraged startups, and, exuberant retail investors chasing easy money.
It was shaky capital, based on perceived promise and momentum.
Today, the capital is vastly different. It's primarily sourced from deep corporate balance sheets. Big tech companies that are highly profitable, holding massive cash reserves.
And powerful sovereign wealth funds making long-term strategic bets.
Which is why Eng assesses the 2025 boom as more stable. The key players, the ones building the infrastructure, they have the financial resilience to absorb short-term volatility and depreciation without immediate default.
They can weather a severe market correction, unlike the unprofitable startups of 2 decades ago.
But the utility of the technology is maybe the most convincing divergence. In 2000, utility was low. We had dial-up speeds, fragmented internet access.
And business models that were often more theoretical than practical, like pets.com.
Today, Eng assesses the utility as high and real. AI is not a future promise. It's deeply integrated into production-grade systems right now.
Solving complex problems in code generation, medical diagnostics, sophisticated supply chain optimization.
The technology is genuinely transformative, which makes the underlying demand fundamentally more durable than the speculative concepts of the late 90s.
However, the risk in Layer 1 infrastructure still carries that historical echo of the dark fiber fallacy reborn, which Eng warns about specifically.
The dark fiber analogy is so powerful because it illustrates the timing mismatch perfectly. In the late 90s telecom boom, billions were spent laying fiber optic cable, the dark fiber.
Anticipating massive internet traffic growth that took years longer to materialize than expected.
And the companies laying the fiber went bankrupt because they couldn't service the debt, even though the fiber itself was eventually used.
So the training infrastructure today faces the exact same solvency crisis if the demand for their trained models arrives slower than expected. But we established that GPUs are even riskier than fiber.
Much riskier. It's because of the asset-liability mismatch. Dark fiber lasts 20 years. If the exponential traffic growth takes 10 years to arrive, the asset is still valuable and eventually close off.
But GPUs, operating under Moore's law acceleration, are often functionally obsolete within 3 years.
So if companies take on $1 billion in debt to build a cluster today, anticipating a specific ROI in 5 years, but the asset loses 75% of its value in 3 years, they face a crippling solvency crisis.
That fast depreciating debt liability is the specific crash mechanism Eng identifies in Layer 1.
Beyond the purely financial risks, Eng also points to several non-financial market breaks that could slow the rate at which the application layer scales, keeping that revenue gap wide open.
Geopolitics is a massive one.
Huge. The U.S.-China technology race and the strict export controls on advanced chips are forcing the creation of parallel, often less efficient, markets globally.
So China, for instance, has to invest heavily in domestic chip fabrication that may be several generations behind.
Which leads to distorted global demand figures and potentially creates artificial scarcity or inflated valuation bubbles in local markets.
And then there's a very practical break, one that Eng is deeply invested in addressing himself, and that's the skills gap.
The application layer simply cannot grow fast enough if there aren't enough skilled human engineers to build the agentic orchestrations we just talked about.
It takes time to teach engineers how to look at incredibly complex enterprise workflows and translate them into robust, multi-step AI agents.
Eng notes. Just as human work is complicated, it's taking everyone a while to look at the very complex workflows and to build AI agentic workflows.
This human capital shortage acts as a governor, ensuring that the application layer growth is inherently slower than the capital pouring into the training layer.
Which increases the risk of oversupply.
And finally, we have the most fundamental constraint of all: physical limits, specifically the energy bottleneck.
This is where finance and physics collide. The computational demands are reaching such a level that growth is being constrained by power grid capacity, not just chip availability.
So if data centers can't secure sufficient megawatts, and many are struggling with this, growth just stops instantly.
It creates this strange scarcity bubble where existing powered data center racks are incredibly valuable, but billions of dollars of brand new unpowered chips sitting in warehouses become functionally worthless until a new power plant comes online.
The AI bubble, paradoxically, might pop due to a lack of electricity.
It's a real possibility.
I mean, it's just an overwhelming volume of data to process, right?
Of course.
The market complexity it's just unprecedented.
It really is. And it's hard to separate the signal from all that noise.
Exactly. So for you, as you're trying to track all this volatility, remember that, objective, data-driven analysis is really key. And if you're looking for ways to track that total market temperature based on valuation metrics that kind of filter out the day-to-day craziness, we'd actually encourage you to search and download the iOS app Buffett Indicator from the Apple App Store.
Right.
It gives you those objective metrics, helps you gauge if the market's, overheating or maybe starting to stabilize.
Okay, so to synthesize Andrew Ng's comprehensive framework, we have to accept that his answer to the core question, is there an AI bubble, is sophisticated. It's necessarily nuanced. It is not a simple yes or no.
Structurally, the answer is a qualified yes. There is likely a bubble in the training infrastructure layer.
This is characterized by capital-chasing redundant model creation, fueled by that synthetic demand, and facing catastrophic rapid depreciation risks due to technological obsolescence.
Conversely, the answer is a firm no. There is not a bubble in the application layer.
That layer is fundamentally undercapitalized relative to its potential. It holds the latent value necessary to sustain the entire technological stack. The opportunity for growth here is still vast, largely untapped, and structurally shielded if capital is deployed correctly.
And the burst of the training bubble, if it happens, may not be the cataclysm the pessimists fear. As Ng suggests, it might be a necessary, almost healthy event.
It would consolidate redundant market efforts, eliminate excess capacity, and crucially, it would lower the marginal cost of compute for the application layer.
Which would finally trigger the true golden age of AI deployment and adoption.
The soft landing scenario depends entirely on a dramatic and efficient rotation of capital. We have to stop funding the 50th General Purpose Foundation model and instead start funding the 5,000th agentic workflow that integrates proprietary data and solves a billion-dollar problem for the manufacturing or healthcare or finance industry.
The genuine, profound utility of AI means the value gap will eventually close. But it's a high-stakes race against the debt and depreciation cycles of that infrastructure layer.
It is.
And this brings us to our final provocative thought for you to carry forward. Shift your attention away from the model leaderboards, that obsession with who has the largest parameter count or the smartest chatbot.
That's primarily PR hype. It's driven by the training layer's need to justify its massive capex.
Instead, start watching the ROI leaderboards. Who is saving their clients the most verifiable money with highly integrated vertical agentic workflows?
That is the true business reality that will close the revenue gap and dictate the long-term winners in this economy. The potential for genuine labor substitution and economic transformation remains immense.
And by focusing on that utility and recognizing the structural differences within the AI stack, we can move past speculative volatility toward verifiable, durable growth. Thank you for joining us on this deep dive into Andrew Ng's tripartite thesis.
We'd love for you to continue this exploration with us. If you found this level of structural analysis helpful and want to access more advanced content and market insights, welcome to join our Deep Value Club membership.
You can also subscribe to us on Apple and Spotify podcasts channel, Deep Value Investing.
And a final reminder, all analysis in this discussion is based on publicly available sources for educational purposes only and does not constitute investment advice.
Please conduct your own due diligence before making any investment decisions.
We'll see you next time on The Deep Dive.